whenever you're watching this now in the future, whatever, it's either the stock market is going to be probably way high. People are going to consider it way high, or we might be in a crisis situation and this thing's going to go lower. We're panicking. It's the end of the world. I've been in this business about 30 years, and I've seen supposedly the end of the world, the end of the banking system about 3 different times. 2000, 2008, 09, and then obviously with COVID-19 and everything that happened here March of last year. So the only way you really are going to be comfortable with investing in great companies, i.e. stocks or whatever, that you do business with every day, you see other people doing business with every day, maybe indirectly you don't know you're doing business with. Like in this computer, there's chips in here. There's things that all kind of people could be using indirectly or directly that you have to believe going forward that they're going to continue on to make money. There's going to be new innovations. Human beings are going to adapt to any situations that's out there. And we're going to have a better world 6, 10, 15, 20, 25 years from now, because usually that's going to fall within somebody's range right now, whether you're just getting ready to retire, maybe you're just getting out of college, whatever. My opinion, you have to have a 6-year horizon roughly or longer to invest in great companies that you think are going to prosper down the road, or new ones that are going to come about that'll change all our world. So that's a big reason you'll want to, if you want to invest in great company stocks, you got to have that belief. You want to be able to try and pursue more than just sitting in cash, CDs, bonds, fixed annuities, that type of thing. You have to want to do that. I mean, some people may have enough money right now based on what they're spending, their lifestyle. They don't even have to go into stock. I've dealt with clients like that, and that's perfectly fine. But if you want to try and outperform cash CDs, you've got to take some risk. You know, the people that I've seen that have become very wealthy over a long period of time, they're willing to take some risk and try and do that. So cost of living, you have to be aware of inflation over the next 15, 20, 30 years. If you're a couple right now, age 60s, and you're getting ready to retire, the average life expectancy is around 82 for one of you. For the second person still living is 92. So there could be a 25, 30-year period that you have to be able to live. And then the cost of living over that time, as the example shows right here, a cup of coffee back in 1990 was about 75 cents to $1. Right now, you go to wherever you want to pick, Starbucks or Panera or whatever, and you add some foo-foo into it, you could be talking $2, $3, $4, $5, for a cup of coffee today. So consumer prices since 1990 are up 2 times. And the only things that I know historically from all the books that I've read, real estate, stocks, stuff like that, historically have beat that consumer price index over a period of time. So like, for example, stock dividends since 1990 are up 5 times compared to 2 times for the consumer price index. And then you have company earnings are up 10 times since 1990, and the prices of stocks in general, we're referring to the S&P 500 index, by the way, when we're talking about all this, up 11 times since 1990. So again, short term, anything can happen. We know right now we could wake up tomorrow and there's something in the world going on that causes stocks to drop 20%. I mean, it could happen. But how do you minimize that risk and also lower your blood pressure but still pursue these returns when you think things might be either too high, they could be going down more? Well, here's what we're going to show you. So what are stock market returns? What have they really historically been? If I ask that to most people, I think I'd get the response 9, 10, 11%. Well, that's not true. The average return of the stock market going back 87 years is 7.4%. This is since 1928, right before the Great Depression. The average, and let me just bring up the big board on this one so you can see it. Let's go here and do that. That's a little better. So if you look here, right in the middle, 7.4% is the average, and that's returns between 5 and 10%. But look on the left side here. The column right here, I guess this would, the column, 0, 5, 10, 15, 20, 25. This is the number of times these returns have happened during the last 28 years. So look at that. Between 5 and 10%, how many times has the market averaged that or done that return? About 5 times. You would be like, that is insane, right? You wouldn't believe that. So the things that freak people out, obviously, are these. Losses greater than 10%, 20, 30. I mean, everything I see is when that market starts hitting 15, 20 is when you start, as an advisor, you might be getting some calls unless you put in strategies in place that might help alleviate people's concern about that. So that's really the kicker. And that's happened almost 20 times. That's still not a lot, but the bigger ones really impact returns long term. You'll see that in a second. But then on the upside, 20% gains or greater over 20 times. 15 to 20, 10 to 15. They're all above 5, 10, 15 times here. So that's the key, guys, is that you're going to see this, if you want to make money in equities, stocks / great companies, if you will. Let me see if I can scroll this up here a little further. Is based on the studies, if you look at this chart I'm going to show you right now, market timing can cost you significantly. I've been in this business, like I said, almost 30 years, and I've seen the greatest investors in the world try to do it, and it's very hard to do. Like Warren Buffett, who's considered one of the greatest investors ever, and he doesn't even try to market time. He believes investing in great companies over a long period of time. That's considered investing. Market timing is considered speculation. And when we're dealing with client assets, we may leave that to about a 5 to 10% of their entire portfolio. We're not in the business of speculating with client assets. We're investing their money to help them pursue their independence, lifestyle independence over their entire life expectancy. But look at these numbers real quick. And I'll go back to the main one here, is that since 1990 to 2019, when this study was done, if you're invested in the S&P 500 at 7.7% a year is what you would have averaged if you just left your money fully invested. So you average 7.7% a year. And that's through all the great crises we've had. We've had wars. We've had the great technology bubble. We've had the banking crisis, the mortgage crisis in 08, 09, and then we had COVID here. You would have thought the end of the world was coming in a lot of those. And again, like I said, I haven't seen it happen yet, and we've got continuing to adapt and continue to innovate. But if you would have just tried to time these things with a majority of your assets, and you just missed the best day of the year down here on the bottom. Let me come back up so you can see this. So best day of the year right here, over those entire 30 years roughly, you would have only averaged 3.9%, right there. 3.9% versus 7.7. That's having your return, basically. And you take a look at what happens to your investments over that period of time with that difference. That's a big deal. And then if you go into the next one, if you miss the 2 best days of the year right here, you only average 0.8%. And then if you start missing the best 3, you're in negative territory return, guys. So this is why we talk about, and this is what's crazy. You miss the 20 best days of the year in this far right column over here. Point over here, a negative 27%. Not good. I would have lost a lot of clients if I tried to market time over the past 3 years. It's almost, again, virtually impossible to do. Show me somebody's been able to do it consistently over a long, long period of time. I'm talking 5, 10, 15 years. Drop the comment down in the section. There are some managers that have been able to do some things, but they're typically really fully invested. So anyway, so that's what I wanted to show you there. Do not market time. You're really venturing into a category that's very hard to do. So we try to put together strategies, kind of what's called win more by losing less. We put our clients' monies, depending on their situation, suitability, all that kind of situations, in different buckets. And any money we're focusing on growth, we consider bucket 3 and bucket 4 money that's not going to be touched for at least 6 years plus, typically 10, 15 years out. But then we're going to implement some different protected strategies along with that involved. And this is kind of what it looks like from a return standpoint to show you kind of what happens. So if you put $100,000 into the market back in March 24, 2000, when we were at the peak of the bubble, the technology bubble, boom, you lost 47%. And then it went back up 120 over the next 5 years, basically. And then it went down 53 in 08, 09, 55.3. And then bam, up 498%. If you would have been freaking out down here, which a lot of people were, and just didn't leave something in or have some kind of strategy in that protected your downside and made it less, you didn't have as uneasy a feeling, look what happened here. All the way back up to where you're at 310,000, and that's even higher today. Versus this strategy on the right, we're losing about half of what the people on the left are, but we end up in about the same situation. So a lot less volatility, still generating returns similar to the growth in the market, but with a lot less risk. So let's take a look at this. So here's some categories. I'm going to kind of draw on this if I can, if my system will let me do this. But if you look on here right now, lower risk investments, cash, bank, money market accounts, CDs, fixed annuities, fixed indexed annuities, people associate these with less risk or guarantees of some type, whether it's backed by the FDIC or an insurance company's claims paying ability or whatever it might be. You should not lose principal unless something crazy happens. But still no guarantees. I got to put that in there. Then you get in this risk line here. It goes above this. Let me go back to the big board. Is that you get into bonds. It could be treasury bonds issued by the United States government, corporate bonds, municipal bonds issued by your local municipalities, states. Bonds can have some guarantees backed by them, but if interest rates go up, you can lose principal in the short term as well. There's no guarantee as to that. And depending on who's backing that bond, that's not an absolute guarantee either. Then you get into variable annuities, and then there's what's called these structured notes, and that's part of what I'm going to talk about. Structured notes issued by big banks, basically the largest banks in the world that will issue these on their investment arm. And these where we're starting to get into growth with some downside protection. Index-linked annuities, structured notes issued by companies, and I'm going to go over these here in a second. Then you get into real straightforward growth, mutual funds. Probably most of you watching this might have a 401k or an IRA with mutual funds in it. And then individual stocks, the Apples, the Googles, all that kind of stuff. These have no guarantees whatsoever. The market drops like you saw in that scenario before, where it went down 50%. If you're something closely tied to that, you're probably going to be down close to that. So we break these off into buckets and when we invest our clients' money. So like this first, let me erase this real quick. Bucket 1 typically is going to be in this category here where it's safer money. They're going to need it pretty quickly. Bucket 2s, they're not going to need it for a while, but still safe. They don't want any risk. And then we get into bucket 3. Actually, bucket 2 goes all the way over here. And let me make this bigger so you can see it again. Bucket 2 is kind of this whole thing here. And then we got bucket 3. This is our protected growth strategies in here. Again, at least 6 years still out time-wise is what we look at. And then bucket 4 we call our treasure hunting bucket. You're really probably not going to touch that for a long time. Afford that volatility, but really try to get big returns greater than the market. Strive to do that. Not guarantee, but strive to do it. So those are kind of the buckets we set up. And here's an example of bucket 3, this protected growth strategy. So again, depending on who issues it, it could be an investment bank like, I can't say any names right now, but just large banks, their investment arms that will issue these. And it could be an insurance company as well, but they're backed by the claims paying ability and the credit worthiness of the institutions. But if you put in 100,000, let's just use an example here. I'm going to make these years. So 1 year, 2, 3, 4, 5, 6. So typically these are anywhere from 1 to 6 years Frequently, it's 3 to 6, somewhere in that range. But then they put these caps on the upside. So you got a cap of growth. So typically right now you're maybe looking at 55% on the upside over 3 years. You can get into 180% over 6 years. So 55%, that's an average of about 15% a year compounding, which is much higher than that 7% I was talking about. But you have the markets have to do that because these are linked to indexes, usually the S&P 500, NASDAQ, things like that. They exclude the dividends, so you're not getting dividends because you're just tracking the index, the price index. But you still have the ability to earn up to more than right now historical, index returns of the market if that were to happen, if the index go up. And then let me go back to this. So if the market goes up and you're in this tracking one of the indexes, and let's say an index goes up 60% over the next 3 years, well, you're going to get 55. The insurance company or the investment bank will keep anything above that. But still, 55% upside potential with this caveat. Look at this, or nice bonus. If the market goes down, so boom, 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 we start crushing through here. We have another round of whatever it is, COVID, another banking crisis. We're down 40%. So the guys that you're at the office or your friends and buddies are talking about how great they were doing in the up market, all of a sudden things have crashed, and now they're like, oh my God, what's going to happen? Should we pull out? All this type of stuff. Well, if you were in a strategy like this, instead of you being down 40% at 60,000, you are only down to 80,000 because the insurance company or the investment bank will credit you back, depending on the buffer you choose, typically around 20% of your loss. So if you're down 40, you only lose 20, if that makes sense. So that is the huge benefit of this. So you're not starting over from $60,000. You're starting at 80. So if the market goes back up, then you have the chance, depending on your cap rates at the time, new caps and all that, is that you have the ability to rebound much quicker than somebody that's at 60. And you're not sucking oxygen during night wondering what's going to happen as much as your buddies will be, because you've got some level of downside protection, again, backed by the claims paying ability or the creditworthiness of the company that are issuing this. So just to give you a couple quick things on this. Oh, back and forth, a little boom, boom. This is some examples over 3 years. So if you have 3-year rolling periods, the average credit on the market since 1957 to 2001 is about 27%. The downtimes, a loss exceeding 20% over 3 years happened 7.38% of the time right here. A loss within 20%, which you wouldn't have lost anything in these strategies, happened about 10.3% of the time. So we're trying to keep you with low blood pressure when these scenarios happen, which is about 17% of the time over 3-year cycles, that you don't have to be freaking out like some maybe your neighbors and friends and coworkers might be if things are going down. Now, you're not fully covered, right? Because if anything keeps going down below 20% or whatever your buffer is, you're exposed to, but at least you've got some comfort level in that early stages, right? And that's typically when, if market recovers, they come back quick. And if you've sold out, like maybe some of your buddies are, whatever, then they're going to miss that upside, but you're still in, it can rebound, if that makes sense. So that's that. And then over 6 years, this was the other very interesting. This is why we kind of look at 6 years. Let me go back at this. If you look over here, the largest 6-year loss tracking since 1980 of the S&P 500 index was a negative 15.04%. So on a 6-year cycle, if you had a 15% buffer on the downside or a 20%, you essentially lost zero on the price index, if that makes sense. So considerations you got to have with these guys, that's all the pros. Obviously, we got to lay out considerations that you have to talk to your financial advisor about. When my clients talk to me, we lay these all out, transparent, so you can see everything in here. Is you have to consider fees. So some of these, the fees on these strategies, they can be zero. I've used 0 ones, and then some of them can have a higher fee up to typically 1.25%. But they're adding in some value that you may not have as a regular managed portfolio. So if you're dealing with somebody right now, they're just buying stock and mutual funds and have no downside protection built in, you're probably paying them a management fee, I don't know, 1%. And then you got the fund fees inside of there, which could be, I don't know, could be as low as 0.05 to up to 1%. So your total all-in fees for some of these strategies that aren't protected could be higher than these. You're like, wow, okay. So you have to look at it all encompassing, right? Penalties, that's the other thing. Some of these will have time restrictions where you can't get the money out. It could be 3 years, could be 5, 6 years, whatever. But usually they'll give you some liquidity ability, either complete liquidity, where you can get it all out, or maybe 10% a year you can pull out if you need an emergency. But you have to consider age too when you buy these, invest in them. If you're over 59 and a half and you're in a fully liquid one, then there's usually no penalties. If you're in an IRA account, you have to watch your age because you have to keep the money within the IRA if you sell out of them, but the insurance company or the other structured notes could have some kind of short-term surrender. Tax deferral, you can do these in an IRA account typically, and 401ks. If you have your own business type thing, usually you can get into them. I mentioned creditworthiness before. That's a big thing. Ability to lock in gains. That's another thing, is that a lot of these old versions, and they're starting to come out new now, that you had to wait to the full maturity date to be able to lock in a gain. So I compare it to like a horse race. So let's say you bet on a horse, you're going to win $10 if he wins. Well, let's say 3/4 of the way around, he's at that 3/4 pole, he's up. But if you take him off the track now, because you're concerned he looks like he might be limping all of a sudden, or something's happened and you want to take him off the track, instead of you getting $10, maybe they'll give you 7, right? So you're not going to get the full gain if you sell prior to the actual maturity date, but versus waiting and all of a sudden your horse goes down, you win 0. So that's the advantage of these new versions they have out now, is you literally have the ability in most cases to lock in gains early. And then considerations there, if you lock in, either going to be sitting in cash for a little bit before you can reinvest it, or some of them do let you reinvest right away. It just depends. So there's a lot of things. Talked about proration of gains because that can impact things if you sell before maturity. Large caps, you really want to focus on the caps, guys, because, for example, if you got a 55% cap over 3 years, usually you're going to be able to, if the market's up 20% in that first year, you might only be able to get 17% of the gain because they're giving you a portion of that gain over the entire period of time, just kind of like that horse race scenario. But if you hold it to maturity or the segment and you say, hey, I want to ride it out, as long as, again, creditworthiness and claims paying ability is still there for the companies, you're dealing with big companies, should not be an issue. But again, I can't sit here and promise anything. When loss buffers are credited, that's another huge thing, and typically why we will diversify into different types of strategies, because some losses, like if you're down 15% in the next year, some of these loss buffers won't cover you until the end of maturity. And you can get some of them actually will cover you sooner, 1 year, 2 year, 3 years. So you get your loss back quicker, like I showed you in that 3-year example. And then you're off to the races where you're starting off at a higher level than your buddies or friends and stuff, neighbors and all that. So you have to look at those. And then dividends are excluded. I mentioned this before, I think, is that you're tracking a price index. So if there's dividends being paid on these stocks, you're not going to get those. So you will have just the price appreciation of the indexes out there. So I urge you guys to think about this. If you believe, and this is going all the way back the last 30 years, some of the greatest inventions we've had. 1990, the World Wide Web, Photoshop, Garmin. Remember the little Garmin thing? Or actually remember the things you'd print, the little flippy navigation maps that you would use, and they'd have little the highlighter telling you where to go down the street. Well, then they came out with the Garmin, right? The GPS. Mobile broadband. Amazon, 1994. Hybrid cars, 1997. Flat screen displays. I remember the first one we bought. I thought it was the coolest thing ever. I remember these big, massive CR2 TVs that weighed like 500 pounds, right? And I'm exaggerating, but some of them might have been close to that. But just the innovation, guys, it's happening. Is it going to happen over the next 10, 15, 20 years? Are we going to adapt? And there's going to be some bad scenarios out there? Yes. But you have to believe that things will get better and there'll be more innovation to be able to do this. And this types of strategy I just showed you now can help alleviate some of that short-term shortness of breath, if you will, when the markets start to drop. You can keep your head on the pillow at night and not be quite as concerned as your neighbor sleeping next door that is telling you, oh my God, it's the end of the world. So anyway, iPhone, I thought, is another big one. Think of that, 2007, the iPhone. 4G mobile gaming, Bitcoin 09. Wow. iPad, which I'm using right now, 2010. So self-driving cars, 2012. 5G just introduced recently. Who knows? Maybe that's the next big one. Nobody knows. But anyway, I greatly appreciate you joining on. If you need to contact us, want to talk about strategies like this, take a snapshot on here. Send us an email, william.wilkins@lpl.com. If you like what you see here, subscribe to the channel. Make sure you pass this on to other people too. You can do that and hit the like button because that helps us get out to more people. Hit the subscribe button, hit the all button, and then there's a share button up here as well that you see up there. You can share that with other people to your Facebook or whatever you want to do. Thank you so much for tuning in. Greatly appreciate it. Have a great rest of your day.
Too many days in the darkness without a glimpse of the light. Running tired and broken and scared, but I swear I'll never give up the fight. I see you broken and beat, head pulled down over your eyes. Every part of you wants to surrender, but darling, you were meant to survive. With every star